Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term is about confidence and sentiment. This month I would like to update you on our ongoing work regarding cycles. There are a lot of cycles of varying frequencies, and I thought it may be helpful to put them in the current context and how we are presently looking at them at MATA-SII as an integrated whole. As such, I would like to cover the following subjects outlined here. One of the leading authorities on long cycles is Harry Dent, who I've interviewed a number of times. The most recent interview can be found at the Financial Repression Authority website with a discussion on many of his well-researched studies on long-wave cycles. You will notice how a number of his various 45, 39, and 35-year cycles are currently all converging during this current point in time. Also, if you look at his longer 250-year, 84-year cycles, coupled with his shorter-term 28-year cycle, we see the same convergent time frame. What's powerful about Harry's work is that he comes at it from many perspectives. If we looked at the Kondratiev cycle or the work of Martin Armstrong and cycles, who I've also interviewed, and can additionally be found at the Financial Repression Authority by searching Martin Armstrong, you find similar convergences. From a historic perspective, we are in the midst of an important period of time. My colleague Charles Hugh Smith put this chart together 10 years ago. On his cycle view research, all suggest a window between now and 24 months from now. As the Chinese expression goes, may you live in interesting times. One of the commonalities of these cycles is how each generation appears to learn the lessons of previous generations, maybe in slightly different contexts, however. As more generations unfold over time, we see even how major societal lessons drift into obscurity. Lessons of sound money, standing on guard to preserve personal liberty, monitoring of the powers of the government, the enslaving powers of debt and why debt jubilees existed thousands of years ago, why currency debasement inevitably happens, and the list goes on. Some cycles are more predictable time-wise than others. This life cycle of spending is one that most can easily relate to and understand. However, because most cycles cannot be detected on a daily, quarterly, or even a single year, they are not something we therefore closely monitor until, of course, something major and unsuspecting occurs and we try and explain it. Then cycles become important in understanding and explaining what is going on below the surface or out of our view. When it comes to cycles, we pay attention to cycles with shorter frequencies. Secular economic cycles and cyclical business cycles are often cited and monitored closely. Financial markets pay a lot of attention to the fear, hope, and greed cycle that I'm sure you are all well aware of. Unfortunately, making money off them is altogether another story, as people can be greedy and fearful for a lot longer or shorter than we might expect. A couple of the conclusions we've drawn over the years that the longer cycles give us periods of time, not specific times, but periods, to set a basis for expectations of transitional change only. These changes do, however, give us a measure of the potential degree of reaction we might expect, from minor to major to crisis levels of reaction. I recall back in engineering school when we had many variables at play in a given problem, we often fell back to simply trying to understand the total energy available in the overall system under study, and only then began putting boundary conditions around it. This allowed us to get closer to an understanding of how to manage, control, or forecast expectations of changes that might occur within the system, like trying to forecast rogue waves in the chaos of this ocean or weather patterns in the atmosphere. Today it has been proven they are both predictable. if you have sufficient data and processing power. The point here is about insufficient data points. And what are those data points? At MATA-SII, we think of these data points as tipping points, which we extensively track, and catalysts, which we map in our themes section and identify through our abstraction methodology. We don't have time in this session to explore this work, but what we can glean is that we are at the end of the debt supercycle, and societal changes, financial, economic, and political, all laid out in the MATA-SII theme section, are showing us that the ending of the current business and credit cycles is one of the most important in decades, and likely the most important one we'll observe in our generation. A clear understanding of where we are in the current business cycle and where we are in the credit cycle is paramount in preparing for what all the longer dated cycles are signaling. Most analysts feel we are in late cycle of this 9-year historically long business cycle. We've shown many charts in various LONGWave and under the lens videos that a recession is highly likely within the next 12 months and almost assuredly within 24 months. A few analysts argue we are still mid-cycle, basically because they see the global economy to be strong. We're not in that camp, but this possibility exists as far as the business cycle goes. We strongly believe, however, that the credit cycle is the most critically important catalyst in today's credit-driven system. The global super-leveraged economy today is being driven by credit expansion, not the prior system of capitalism, which was dependent on savings, and that savings being invested in a productive asset as the primary driver of economic activity. My colleague, Richard Duncan, is out with a 50-slide piece of work showing the degree of current emerging shortages in credit expansion, which he feels we'll soon face, and I happen to agree with him. I encourage you to subscribe to Richard's Macro Watch with a special 55% discount to his work, which anyone can take advantage of by using our special code FLOWS, F-L-O-W-S. Before I get into our work on the credit cycle, let me make a couple of other salient points. Commodities are very cyclical and can be seen here to be following multi-decade cycles against the ratio with equity prices. Rising commodity prices due to inflation and currency, along with falling equities, would begin to reverse this chart. Commodities have lacked the longer-term, capital-intensive investment in mining required to sustain low commodity prices for a decade or two now. No more is this more evident than in gold and silver mining. Commodities are very dependent on financing and investment flows to the emerging markets as the primary producers of most commodities. The dominant sources of these flows has traditionally been the European Union banking sector. We do not believe the EU banking sector problems were, however, resolved in the 2012-2014 crises. In Europe, instead of writing off the bad loans and recapitalizing the banking system, they instead used 1. The International Monetary Fund, 2. The World Bank, 3. The European Investment Bank, 4. The European Bank for Reconstruction and Development, 5. Bilateral loans, 6. Loan facilities, 7. The European Financial Stability Mechanism, 8. The European Financial Facility, 9. The European Stability Mechanism, 10. Longer-term refinancing operations 1, 11. Longer-term refinancing operation 2, zero interest rate monetary policies, 13. Negative interest rate monetary policies, and finally number 14, quantitative easing monetary policies. And I think I probably missed a couple. I didn't mean to bore you with that, but it tells you the degree of money that came in to bail them out and keep them alive that can't be sustainable, all to save the day. Effectively, they simply papered over their banking problems, which now hides, through the likes of the ECB's corporate sector purchase program, the bad corporate balance sheets of zombie corporations, which we discussed recently in our private debt and the feeding of zombie corporations two-part series. Any financial crisis in the EU will have a major impact on emerging markets. Separately, and the corollary of this, because of the $9 trillion of U.S. dollar-denominated debt incurred in emerging markets since the U.S. implemented quantitative easing, their debt rollover is now at increasingly higher rates. At MATA SII, we think this may be the catalyst in igniting problems within the EU banking sector and to drive a spike in the US dollar. With the level of the EU zombie corporations currently dependent on the debt for their existence, we foresee a significant spike in corporate bond spreads as well as credit dramatically contracting. We talked about this during what we called the echo boom many years ago, and in the 2014 thesis paper, The Globalization Trap. Consider this in the way of backdrop when we talk about the credit cycle in a moment. We've pointed out numerous times that the global credit impulse stemming out of China is a major signal and is certainly one of the reasons why the People's Bank of China recently eased its reserve ratio requirements. Surprised everybody. But stemming this tide is going to still cause collateral damage for those least able to cope. The banks have long since started pulling in their credit horns in anticipation of a slowing global environment. I'm not saying credit is not there. What I'm saying is that the rate of credit growth has slowed sufficiently and potentially will not keep abreast of global credit needs going forward. This will be perceived as a credit contraction when in reality it is a supply squeeze. This is one of the reasons we at MATA SII, as part of our strategic investment insights, look at a completely different yield curve for credit than most do. For example, we look at the private sector yield curve as measured by BAA corporate bond yields minus the average bank prime rate. This helps us better understand global liquidity, credit, and flows, which we have recently elaborated in a separate Under the Lens video. This is our simplified credit cycle roadmap. As you can see, we are only at stage 3 in this model and still have a ways to go. We think the expected follow-on shocks from the VIX shock on February the 5th of this year won't likely occur until this fall, as shown on the right side of this particular graphic. There are many indicators that still need further deterioration in our estimation. However, we need to stress this. Never underestimate how quickly and abruptly they can all change, as we saw in the equity markets on February the 5th. We think this cycle chart is very instructive in that regard. Traders, analysts, and strategists have been stumped by a market paradox in recent weeks. Despite earnings that have been off the charts, rising 24% year over year, the most since 2010, if largely thanks to Trump's tax reforms, the S&P is still down for the year, marginally, after a torrid melt-up start to 2018. How come? While many have offered explanations why the market refuses to break out higher, one of the most convincing observations is that it is all about rates, both nominal and, importantly, real, and how they influence risk assets. That particular interplay is especially notable because whereas straight market correlations between both nominal and real yields and risk assets tend to prove unstable, they can be thought of as following a regular cycle. It all boils down to one thing: competition for global investment flows. Think of these 5 steps as, while risk assets like credit tend to respond positively to early signs of inflation and growth, once these give way to recognition that central banks will have to withdraw stimulus and raise rates, manifested in rising real yields, at which point risk on turns to risk off. This continues until eventually central banks are forced back into easing. Lower real yields, prompting investment flows to return to risk assets, and eventually completing the cycle by helping to drive optimism about growth again. This was the essence of our March Under the Lens video called Global Liquidity, Credit, and Flows, where the money seeks real rate of returns adjusted for inflation and currency. Separately, never forget that the Fed, by raising rates, has a history of bringing on financial crisis, as well as at the bottom by sufficiently lowering rates. It is the source of a rebound. In a credit-driven economy, never have rates been more important than now. Rate differentials are the central drivers of a credit-driven system. The obvious role central banks play in this cycle is that they are the de facto catalyst, whose monetary policy interventions serve to mark the trough and peaks in the cycle once risk assets hit the so-called Fed put, whose new strike price under Jay Powell was quantified recently by Deutsche Bank as roughly 23 to 2400 on the S&P 500. Central bank action trigger the lows and peaks in the rate cycle, which match with the real rates. The real yield curve fits relatively well with both credit and equity moves over recent decades, and would suggest that risk assets will continue to be vulnerable, and that even if yields start falling again, it may well be as part of a flight to quality. Historically, equity markets respond negatively to what is forecast to be or are experiencing a period of protracted negative real yields, with one important modern-day difference. When massive amounts of money and credit are being created, we get asset inflation, while for whatever reason the currency maintains relative stability. This is what happened during quantitative easing and is still happening, as the ECB and the Bank of Japan are still injecting approximately 50 to 100 billion per month of part of Bernanke's policy of enrich thy neighbor. It all comes down to an end in stage 4, when real global rates go negative again, one of the central definitions of financial repression. All the amplitudes of the cycles will then likely resonate together and suddenly cascade a markets abruptly lower. I need to point out that many argue correctly that we are not yet properly in phase 3, that risk assets are going sideways rather than selling off, and that this phase could and likely persist for a while. The standard late cycle, not end cycle argument. So pay attention and don't get impatient. No matter what, market development this year has become more rather than less ominous. Just as central banks were the driver for risk assets to hit all-time highs, so their reversal will unleash the next correction bear market crash. Despite the Fed's balance sheet having shrunk by $100 billion recently, despite a mature credit, business, and real yield cycle, despite a bevy of geopolitical risk, stocks both in the U.S. and globally remain just shy of all-time highs. However, inflows to risk assets have basically stopped. Mutual fund inflows have stopped. Foreign buying of U.S. treasuries has abruptly started to slow, with dollar weakness causing dollar hedging costs to rise. Foreign buying of U.S. credit, for long a mainstay of market demand, fell to zero in November and has not revived significantly. While there has been some rotation towards Europe and Japanese buying, this has not been nearly enough to offset the reduction in the U.S. As more chairs are withdrawn, expect more consensus trades suddenly to come under pressure, and don't be surprised if more than a few investors find themselves left standing awkwardly without a chair as a result. So in closing, as I often do, remember, they will print the money to solve any and all problems until such time as no one will take the money or currency, or it has no value at all. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. I would like to take a moment as a reminder: do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2018 be an outstanding investment year for you and your family. And I thank you very much for listening.